Welcome to this explainer. Today, we're opening up the AI investment memo to take a hard, objective look at a company you probably misunderstand. I'm talking about Rayonier, ticker RYN. Now, when you hear that name, your mind probably jumps straight to, endless forests, quiet growth, maybe a pretty boring business model. But actually, scratch that. That is no longer the reality. We're diving into a comprehensive memo today that evaluates Rayonier not as a simple tree grower, but as a massive, complex, post-merger behemoth.
Which brings us to the core mystery of our analysis today. Is Rayonier actually a great business, or does it just happen to own great land? For years now, investors have been debating this. Is this asset a durable compounding machine, like a business that steadily generates exceptional returns year after year, or is it merely a highly cyclical operation, just riding the waves of real estate hype? To figure this out, we need to look way past that attractive narrative of just owning land and really dig into the nuts and bolts of how they actually make their money.
To understand where they are right now, we've got to take a really quick look at how they got here. Rayonier's history, it is definitely not a straight line of steady business compounding. Tracing their roots all the way back to 1926, they eventually went through a major reset in 2014, spinning off assets to become a pure-play timber REIT. But the real kicker? The biggest shift just happened in early 2026 with the massive Potlatch-Deltic merger. So the through line here isn't one stable business model, it's constant portfolio repositioning. These guys are opportunistic asset recyclers.
Because of that, relying on old narratives here is incredibly dangerous. The legacy Rayonier was a pretty straightforward story, right? A timber REIT with some real estate optionality. It was basically all about the dirt. But the new Rayonier, it's timber, plus heavy manufacturing, plus incredibly complex post-merger integration. If you're analyzing this company using the legacy framework, you're literally looking at a ghost. The entire foundational structure of this enterprise has been completely rewritten.
And the sheer scale of this new 2026 platform is absolutely staggering. We are talking about over 4.1 million acres of land spread across the U.S. South and Northwest. That's a massive footprint. But more importantly, the portfolio now includes 6 sawmills and an industrial plywood mill. So this isn't just about trees anymore. This is a definitive, directional shift toward manufacturing and highly cyclical wood products. And while that definitely raises their earnings ceiling, it also brings a whole lot of daily operational headaches.
The math on this recent merger is just wild. When Rayonier merged with Potlatch-Deltic, they weren't just bolting on some small tuck-in acquisition. No, Potlatch-Deltic represented nearly 60% of the combined company's total assets and revenues right out of the gate in their first post-close quarter. The merger essentially swallowed the legacy company whole. So, as an investor today, you're buying a heavily integrated wood products giant, not a passive landowner just watching the trees grow.
So how does all this new reality actually translate to cash? Well, you hear a ton of market buzz lately about land-based solutions. Things like leasing land for solar farms or carbon capture. But take a look at this breakdown. Visually, that highly hyped narrative is just a tiny, tiny sliver of actual revenue, just hovering around $3.5 million. Meanwhile, the massive dominant revenue drivers are those highly cyclical traditional businesses, wood products and timber. Look, those future tech narratives are fantastic options to have in the back pocket, but let's be real, they are not the things paying the bills today.
Which brings us to valuation, and specifically, this number right here, $1,822. That is Rayonier's estimated enterprise value per acre right now. On the surface, a bull case investor might look at that and scream, no way, that is incredibly cheap compared to the thousands of dollars land can sell for. But the memo really warns us that this is a dangerous illusion. Applying a blanket premium valuation across 4 million acres of what is mostly commodity timberland, well, that's a fundamental misunderstanding of the asset.
The absolutely crucial point here is understanding the difference in land use. Yes, management can and actually has sold select prime tracts of land for massive premiums. We're talking like an incredible $10,100 per acre to a solar developer. That is real optionality. But the vast majority of their land base commands standard, much lower commodity valuations, hovering closer to that $2,000 an acre benchmark. So, the big takeaway? Optionality definitely exists, but it's incredibly uneven. You simply cannot value the whole forest based on the price of the single best tree.
So let's take a second to audit the leadership team that's actually driving this machine. When it comes to strategic vision and adaptability, they score a solid strong. They recognize a valuation disconnect, stopped just complaining about it, and actually took decisive action, selling off assets for hundreds of millions and resetting their leverage. They act like true capital allocators. However, operational execution, that gets a fair rating. Why? Well, because executing a massive merger and running cyclical sawmills requires a completely different skill set than just selling off plots of land. Their ability to run the factory smoothly is still, frankly, unproven.
And this execution gap leads to a really interesting conversation about incentives. Take a look at 2025. Management was paid out at nearly 150% of their target annual bonus. They were paid very handsomely for successfully executing strategic deals and reshaping the company. But notice the disconnect here. This massive payout was driven heavily by deal-making, not by proven, recurring, per-share economic compounding. Essentially, they're being rewarded for building this huge new engine, but we don't actually know if it runs efficiently yet.
And checking if that engine does run efficiently is actually pretty difficult right now. In early 2026, management's adjusted financial framing excluded over $70 million in merger-related costs. Now, excluding one-time costs isn't inherently improper during a huge transition like this, but it's definitely a massive caution flag. True, normalized earning power is currently completely clouded by these heavy add-backs. When an investment story depends on multiple layers of financial normalization, you really need to read the reported cash flow with a heavy dose of skepticism.
Because out in the real world, just owning millions of acres doesn't automatically equal bulletproof profits. The execution wildcards here are severe. First off, they have to actually capture those promised merger synergies. They're also deeply exposed to the wild swings of manufacturing cyclicality and lumber prices. Plus, real estate sales are inherently lumpy. And get this, remarkably, they are temporarily excluding PotlatchDeltic's internal controls from their annual assessment. That means their largest operating component is temporarily outside their full historical control perimeter. Those are some very real integration frictions we're talking about.
So what would it actually take to upgrade Rayonier from a cyclical trade to a durable, long-term core holding? Well, here is the rapid-fire roadmap. First, we need 2 to 3 years of hard proof that these post-merger synergies are actually real. Second, cash flow needs to cleanly cover dividends without having to rely on lumpy asset sales. Third, those exciting solar and carbon options we talked about, they must scale into material economic drivers. And finally, we need transparent, whole company return on capital metrics.
Which leads us to our final decisive takeaway from the memo. Rayonier is a watch list, not portfolio core stock. Look, it's a highly active company with credible optionality and massive scale, but the burden of proof for this incredibly complex post-merger model remains unmet. As an investor, you're basically being asked to underwrite a lot of unproven execution. Thanks for joining me on this explainer. The land is undeniably great, there's no arguing that. But the ultimate question you have to ask yourself remains, can this management team master the factory floor as well as they've mastered the forest? We're going to have to wait and see.